Hello everyone and welcome to our June 11th, 2014 current session review, last hour of trade and preparation for the next pit session. It's currently 3:15 Eastern and Jim Dalton will narrate this last hour, discuss what happened today and get into the preparation for tomorrow to give you a better sense of what he does. And with that, of course, as always, we are recording and we welcome your questions on the dialog box there. And I will introduce Mr. Jim Dalton.
Well, good morning or good afternoon wherever you are. It's just turning afternoon here. Let me start with some slides that Julia prepared for us. The first slide that I captured was at 10:45 Eastern Time, so you know how long the market's been open. The reason I thought it was important to understand this morning is that first of all, I usually go out for a bike ride and I ride about an hour before the market opens in the morning. It's getting very hot out here, so I go out at, sometimes 4:30, 4:45. I didn't go today, and the reason I didn't go today is I found I was overly anxious and I had to make sure that I was prepared to manage my expectations. As I have written up these markets, for those of you that get the reports, and those are mostly people that have already enrolled for the upcoming July intensive. One of the things that I've been writing about, and let me go to the live screen for just a second. So one of the things I've been writing about was the excess high that occurred on Monday. Following an excess high, it is very common that the following day, and this is an all-time excess high. We don't know if it's going to last, but it's all-time for now. Following an excess high, you normally get a rotational balancing kind of day where there's a lot of confusion. Obviously, the excess high was created because somebody either started to liquidate or some selling came in, but there's still a carryover of people that are buying every dip. So it's pretty common on the day following an excess high to get a balancing rotational type day, which is exactly what we got yesterday. In the past, when we've had a really solid high and then leads to a reversal in the market, the strongest sign of that occurring is a gap down on the third day. So when it came in, today being the third day, when I came in today, when I woke up this morning, and I must admit I snuck a couple of views overnight, I saw that the market had the potential to gap lower. This was the settle yesterday where the green arrow is. So 100% of the overnight inventory was short, and the market at the time that I was talking about it, we had a potential gap, which would be a huge signal to the downside. Now, additionally, I see it as a gap. Some of you out there I know would see that as an island reversal and also a very big indication of a reversal in an auction and the start of a new auction to the downside. So, and I had some puts. I had a fairly nice position that would really like to have seen the market break to the downside. So when I'm talking about I had to manage my expectations, that's exactly what I had to do, because I'm like anybody else. I'd love the home run. I just love the feeling that it gives you. But when I looked at this market, I said, all right, what am I dealing with? I've got inventory that is 100% short. I believe it's now 8 out of the last 9 days, and I believe counting today, it's 9 out of the last 10 days. There has been a counter auction or a correction, at least a partial correction, to overnight inventory. Overnight inventory is something you hear us cover all the time, And Julia did a test during the last 60-day intensive, and 65% of the time there was a correction or a counter auction relative to the overnight inventory. So
Jim?
Yes.
I hate to interrupt you. Real quick, just an excess high.
An excess high is, you'll see on Monday, auctions go until the last bidder bid. If an auction is a good auction, it should fall away from that very quickly. Single prints are a sign of an excess. This would be excess single prints in the day time frame. It would also be excess on a daily bar. Excess and balance are the two most important concepts we ever deal with. All right, after we've gone to that definition, now we look and I come in and I say, okay, overnight inventory is 100% short. So that's the first caution I have as to managing my expectations. The second is I have a very prominent point of control at 1947.25 that has not been revisited. And I'm very prominent, being the widest from left to right. And there's no exact number, but it's obviously a very wide, it's an anomaly. And when you have those very prominent points of control, that always increases the odds that the market will rally back to retest that point of control. So at this point in time, I have started to taper down my enthusiasm to think that I'm going to have a home run on my hand. So what happened, and if you'll see on the right-hand side over here, and this is on the next slide we're going to show. Let me go to the slide. I think that'll make it just a little clearer. Okay, this is a slide I took an hour and 15 minutes after the market opened. Early morning, the market opened where the green dot is. And that meant that the market did not technically gap lower. Now the Dow gapped lower, we didn't technically gap lower. We traded back and forth through the opening, up to the high, back down. Finally, the market went down and mechanically filled the gap to the tick. The gap would have been filled at 1940.75. This is the gap on the far left. It filled it to the tick. When I see a gap fill exactly to the tick, or anytime I see a market go to a very visual reference exactly, there's tremendous valuable information contained in there that tells me that the people that were buying at that level are daytime frame or short-term traders. Daytime frame being people that come in flat and go home flat, or short-term traders, which are maybe 3 to 5 days, maybe a little longer. Long time frame traders do not buy exactly at the gap. They don't even know where it is. So when I see the trade exactly at the gap and a rally, I know that what I'm looking at is short-term trader, because day and short-term traders, this is the type of behavior that they exhibit. And that is extremely important to know if you're going to be a successful trader over time. You have to know who you are competing with. If the long-term sellers were in this market, we would have gapped this morning and we would have gone down, straight down, without looking back. The fact that it went exactly to the gap told me that I may be getting liquidation following the excess high. Whoops, what's happened here? I may be getting short-term liquidation following the excess high on Monday, and some liquidation yesterday and some more liquidation today. But it is very unlikely that at this point in time I am seeing any meaningful or significant selling by the intermediate or longer time frames. And that is very important to know. There's a whole difference between a market that goes down because of liquidation and the most potent kind of break, which is the combination of longer time frame selling along with liquidation. Right now, predominantly all I'm seeing is liquidation in the market. So when I look down, this is the slide we were showing with the C period low. When I look down there, I'm not very impressed, and I don't think I've got a lot to go on. I think I've got some short-term buying, but I don't see any indication that I've got any serious new long-term selling. Very important. Remember, I started this with being able to manage my expectations. And I was very pleased with myself because all that excitement that I woke up with thinking, do I have the big run, the home run? Boy, I mean, I'd like it as much as anybody else, and I'd like you to believe that, you know, I'm calm, cool, and collected all the time, but I'm not. I get excited like anybody else. That you can't trade and not have emotion. The key is you're trying to control and manage your emotions. You need the emotions to make decisions, but you don't want to become overly emotionally involved, or you'll start making impulsive type decisions. So now I've got the markets open. I've got a pretty good idea what I'm dealing with. Let's go back to the slides. The market now rallies, and I know this is kind of, let me make this just a little bigger. I know this is fairly small, but if you look, the white line is exactly half back in the overnight range. Now, most of you that have heard me talk about overnight trading have heard me say that I only look at the overnight high, the overnight low, and is the overnight inventory long or short. However, those of you that were on the last 60-day intensive have heard me talk about a nuance involved with trading in the overnight, trading relative to the overnight market from time to time. Not the general rule, but something occasionally. And when I have, if I have a double distribution in the overnight market, that's a sign that something did change. So something changed right at the level of the overnight market. So I will pay some attention to that level. That happened to take place at exactly half back. So the market rallies this morning to one tick below exactly half back in the overnight range. Do you think that the longer term traders have any idea where that is? Nor do they care. They would laugh at me and I say, well, you know, the market went half back in the overnight trade. They would look at me like it was crazy. Real traders understand what I'm talking about. But again, when I see it go to that level, that is more confirmation that not only was I dealing, that I didn't have any longer term money on the sell side, I don't have any longer term money or serious money on the buy side. What do I have? I have short-term sellers, liquidation. I have short-term buyers. I get short-term sellers or daytime or short-term sellers up here. Very, very mechanical. Now, as the morning goes on, I came a few minutes later and I took another screenshot. And that was only about 16 minutes later after I made the low. Well, let me go back. I'm sorry. I forgot to point out one thing. Circle the volume down here, 18,000 contracts and 18,018. I circled this volume. The system that you're looking at here is Window Trader Blue, and I use predominantly Window Trader Blue for my short-term trading because I like to see the actual numbers. Now the histogram is to the right, so you can see both from the histogram as well as the actual volume. The actual numbers mean more to me than the histogram. I just, for some reason, I retain the numbers. When I see I've got 18,000 contracts here, you know, 10,000 more than here and substantially more than here, that becomes pretty important reference to me, and it coincides with this low. So I think I probably have a short-term low in the market, and so that's that's something to trade against when I see that number. Okay. Okay, so now I'm back to 1101. 1101, I'm looking again, and the market is rallying. Again, I'm just looking to see what's happened. It's come off that low. It's come exactly to half back. And again, the half back from the overnight is still holding and still in place. So there's nothing in here Another 15, 16 minutes later, it tells me, at least on a temporary basis, the low is good. So I have a morning low. I have something to lean on. I do not have a good high, meaning no single prints. Okay, as the day goes on, I take another, am I getting confused here? Another screenshot. Nothing's really changed. Then, as I come later this afternoon, I take a final shot before the webinar at 2:21 p.m. Now, here's what I want you to recognize. The overnight low, which we've already talked about, notice the market never took that out. Again, let me ask you the question. I mean, you know the answer. When it doesn't take that out and it comes exactly to it, what kind of trader am I dealing with? I'm dealing with day and short-term traders. So the market, first what happened, the market ran up early. Then we traded up to the A period, down to C period. So let's call that auction 1. We get the inventory probably a little short in the day time frame. Then we get an inventory rally back up to the high. It falls one single tick short. When it falls one single tick short one more time, that gives me a pretty good clue that I am looking at very short-term trading. It moved sideways up there for about an hour and a half, a little better than an hour. Now, I tell the story years ago when I traded on the floor, when we traded on the floor. You know, if the story, it was a made-up story when I did webinars or seminars. But, you know, you pull your handkerchief out and kind of flip it palms out like you were going to, you know, get it ready to blow your nose. And everybody thinks you're selling, and all of a sudden, all the short-term traders in the crowd start to sell. On the floor, palms out meant sell, palms in meant buy. So if you just picture taking your handkerchief out, flipping it, hands, palms out, everybody starts to sell. All that happened was a liquidating break. Liquidating breaks from short-term traders are just their way of balancing inventory. So more than likely what happened in the morning, we got the market too short early on, combined with the overnight, we rallied off the opening. We had too much short inventory from overnight. Then they sold it off again. They got it too short. There probably hadn't been enough time for all the overnight to cover. We get a short covering rally, inventory coming back into balance. It moved sideways here for better than an hour, so at about an hour and a half. So at this point in time, guess what happened? Inventory's getting very long again. And then you turn around and you get another inventory break this afternoon. It goes back down, takes out the morning low, and goes to one tick shy or two ticks shy of a very later on it went down here to the very prominent point of control from several days back. So there's really nothing going on in this market other than, now let's change time frames for a second before we open this up to questions. I'm going to go back and when I'm looking, this is the value from Monday. I get lower value yesterday, and I'm getting lower value again today. Now, I put a low in down here today. It goes one tick shy of this very prominent point of control, and then I get another excess low. But remember, I had this very poor high from this morning. I have this very prominent point of control that has not been revisited. So when this made this low, all we're getting now is another inventory correction back up towards the morning high. We have another very prominent point of control. So there's really nothing going on today from a short time frame. However, from a longer time frame, we have an excess high, lower value, and unless something happens in the next 25 minutes, we're going to have lower value. Well, we're going to have lower value today. So we're in, tomorrow is probably a fairly important day. If in fact there is anything on the downside, this market should open down and take out today's low and be the third day in a row, lower value, third day in a row of lower value. If we get that tomorrow, now let me show you something else. If we get below this base right in here, the single prints from this level, which is 1929.50, up to, and I'm going to call it right here at 1936. These very thin prints, if this market can get below this node up here, more than likely we will cut through this very quickly because there's really no support in there. This provides some support. It's kind of fat. There was a lot of trading that takes place. Any place that's been prior trading usually offers some kind of support. And that's exactly where it went this morning. But if you get below this level, there's nothing to support it here. So it could fall very quickly. Something you've got to be aware of. But for tomorrow, because lower excess, all-time excess high on Monday, lower value on Tuesday, lower value on Wednesday, and remember, it's important. We trade value, not price. If you were trading price this morning, it was really very easy to get misled. If you're looking at if you understand who was controlling the market today and say, all I've got is liquidation and short-term traders, then I'm looking for exact levels, and we filled the gap early on to the tick, an exact level. One tick below the overnight high, an exact level. You know, who do I have controlling this market today? You get a liquidating break from inventory down here. It goes into the middle of this, you know, heavy volume, and now we're rotating back towards the high. But for tomorrow, if I open and trade up in this area tomorrow, well, then all I've got is a 5-day balance. 1, 2, 3, 4, 5-day balance, and I have nothing going on. I still don't have any significant change relative to Monday morning. However, if I open and start to build value down here tomorrow, now I have an excess high, lower value, lower value, lower value. I have a pretty solid short-term trend to the downside. Okay, Julia, I've talked about a lot. Let me take some questions.
Okay, great. Thank you, Jim, very much. What behaviors would tell you that there are other time frames in the market other than short-term traders?
Well, let me. Who asked that question? And I'm not trying to be flip, but let's look at it.
She's going to be attending the first intensive, so she's relatively new.
Okay, well let's work at it backwards. Let's ask if there were other if there was other longer-term money in the market, what would you not see? That is actually probably the best way to come in it. You would not see the market stop exactly at where the gap, or I'm sorry, right here, exactly where the gap is filled, and one tick short of the overnight high. You wouldn't see those. Overnight
one
low. Tick short of the halfway level of the overnight profile. You wouldn't see those type of things. You wouldn't see a market that's very truncated like this. You wouldn't see these very prominent points of control. When you have longer-term money in the market, you'll get much more elongated profiles. You don't want them too. If it's too thin, that's probably short covering or long liquidation. But you get profiles, say in the S&Ps, you know, the market's moving, it doesn't get more than 4 or 5 wide, and it moves to another level. But there's some rhythm to the market. The profile doesn't get overly truncated. So I really come at it more from what didn't happen. And I've often said that a lot of times what doesn't happen is more important than what does happen. You know, if I don't get through, if I stop exactly in the gap and don't trade through it, I just know from experience, I don't have any longer term money there. If I did, it would cut right through that. So I really come at it more from the point of view of looking at the behavior of the day and short time traders. They go to exact references, markets are more truncated, etc. I hope that answers the question.
Please come back, Gail. And also, you know, you do talk about the elongation with those thin single prints that push the market out of range that you were referring to, you know, would be probably slice right through that if it gets below the upper node. That would be not necessarily long-term, but you've talked about the profiles being elongated. I guess that's not really long-term money. That was momentum traders, and
this is probably,
the trend is up.
Well, if there's something that long-term selling wasn't here, they weren't in here selling. This is an upside, you know, this is just an upside breakout. The market traded, the market got to the magical 1900 level, and we gapped. Okay, let me talk about a gap for a second. A gap is a reordering of business. Usually, when a gap occurs, it is a sign of longer time frame participation in the market. That doesn't have to be overwhelming, but you know, and when we talk about longer time frame money, it's not always the very serious portfolio managers. There's other longer term money that trades very aggressively. So my guess is that when we get to the 1900 level and we trade above it, we brought in some, maybe not portfolio managers, you know, to buy and hold for years, but we probably brought in some longer term money and some very aggressive, you know, hedge fund money that can run into the, you know, a billion, hundreds of million, and a billion. They can be pretty large. So intermediate, short-term money could be in that market. But you have, when you get a gap, it's a sign that something has changed in the marketplace. Now, you've all heard the term, you know, is an acceleration gap or an exhaustion gap. And yeah, I look to see that. In this case, it's an acceleration gap. The market gaps higher, and this was actually a holiday trade, so it's a pretty healthy gap. So that's a sign that something has changed. There's a new line of thinking. Maybe it's just the longer-term momentum traders or, you know, the bigger pools of capital saying, okay, we've got another run to the upside. We've got another breakout. You don't want to fight those gaps. That's an indication something has changed, and something has changed to the upside. Then the market one-time framed higher. One-time framing means that this low did not take out this low did not take out this low did not take out this low. The first indication that we got that anything was slowing was right in here on the 2nd of June. We did take this low out, but then it rallied again. And one of the things that Julia has pinpointed so well is a lot of times these rallies get underway, and they're actually fueled by short covering. And you say, well, wait a minute, how can we have short covering when the market's in new high territory? Very easy, because there are people that are just continuing to be adamant that the market should be sold. So, you know, there's a lot of people, I'm sure, that when this market gapped higher, they were selling into the gap. They were selling, oh, this is a great opportunity to sell. And they sell and they get short, and I suspect that's what happened here. And they had to, you know, they had to rally and cover shorts. And that fuel, that, as she so aptly puts it, that fuel can continue to carry the market higher. Plus, you've just got the normal momentum traders that are just going to buy every new high. So I think that's what's going on. Now, we look this overall to see the quality. When we see these are not elongated, we have a pretty good, and this is not elongated, this is not elongated, there's two down here, two elongated, stubby. We know that we're getting fairly late in the game, Inventory is getting longer and longer, but nobody has stepped forward to become a seller yet. There's really no longer-term money has stepped forward in any seriousness to sell. But the market's getting heavy, and you have to let an auction go until it's over. One of the things we continually talk about to understand the markets, they are continuous two-way auctions. We auction from low to high and high to low constantly. Let me go back to the slides for a second. That's what I was trying to show right here on a very short-term basis, even though it's mostly daytime frame traders. They auction up, they auction down, they auction up, they auction down. It's a continuous two-way auction process. Now, these auctions break down into smaller periods than that, too. But generally, I keep it all in a 30-minute bar. 15-minute bars or something smaller than that hides too much of the important material that I need to see. But you get that feeling of the two-way auction in here. And so it's rotational. When you get a trend day, you'll get the auction, it's only going one direction, and you won't get the rotation. That's a sign that you've got a trend day underway. So, you know, but the auction goes until the last bidder bid. The example I give sometimes, if I go to an auction, and let's say that I think I'm very wise, and I know that auction's only worth, that whatever's being auctioned only worth $100,000, and it gets to $100,000, and I get very smug, and I think, oh, that's as far as this auction's going, that's all it's worth. And all of a sudden, I hear the auctioneer say, new bidder. Well, guess what? Are higher prices cutting off activity, or are higher prices bringing in more activity? When I hear them say new bidder, higher prices are bringing in more activity. When I look down at the gap, when I look down at this gap above the 1900 level, you know, some people were shorting this, thinking it was too high, but you know, higher prices are bringing in more buying, not cutting it off. So those people that hate the market and are fading this market are probably going to get hurt, because the market's going to continue, the auction's going to continue to run them over until you get some sign that the auction has run its course. And that's why I start focusing here on Monday when we get an excess high on Monday. And we get a test on Tuesday. I said, okay, we got the excess high, we got a test on Tuesday, and now I've got lower value again on Wednesday. I said, well, my short-term auction's looking pretty poor at this point in time. But, you know, as you see, I haven't really broken away from it yet. Even though I've got 2 days in a row, I got a little short-term auction on the downside, I've really got to get another day to get down below this level. Tomorrow's the first day I think we get some news this week. I think we have a little bit of news tomorrow and Friday. Okay, I did a lot of talking. Some questions that are floating around out there, Julia.
No, that's great, Jim. Thank you. And also, you know, on our public articles at our site, there's an article called Forcing Action. It's number 80, and it talks about how many times these prominent points of control, like we saw from Wednesday last week, from Thursday last week, was revisited. And it's an interesting article, so if you want to check that out, it's Article 80 at our resources section on our site. Jim, this morning, after the excess period in J, where and when would you have entered a trade with would you have the target of the poor high at the A period from today's in the morning?
The answer is yes. Yes, exactly. I can tell you where I entered the trade. Hold on, let me look at my 1939.29 is
25.
25. 1939.25 is where I entered the trade. Now it went a little lower after I entered. It went to 1938.25, but you know, I decided to fade the move a little bit because I thought it was slow and I thought I was getting just liquidation. I thought the morning high was very poor, and I also thought that this very prominent point of control up here could still have a potential.
From 1947, yeah.
From
okay.
1947.25.
From yesterday.
Level, yes.
And it was fat today too, right? The structure, I mean,
correct.
to act
Yes,
as a magnet.
It was fat up here, which is more of an indication that the market was getting itself too short. Now the next question that comes is, where do you put your stop? Well, you know, that's a tough one. The stop's someplace down below you know, this prominent point of control. Anyhow, I don't normally tell you where I entered because it is not important. It is not important, you know, where I got in or where I got out or anything else. I will tell you that I am out of this trade right in here. I just reached across when we were talking, and I exited the trade, and I'm looking at the order. I didn't even see it was filled at 1944 even. So before I back up, why would I sell it 1944 even when it's so close to the high and a good possibility that high will be taken out? Those of you that have been in the last 60-day intensive or have heard me before will know on a short-term trade that I will exit as we get up near the high, because if there's going to be a problem, that's where it's going to be. So, I mean, I just pushed, we were here doing the webinar, I saw it up there, I just turned sideways and hit click and got out. And I didn't care about the price, I just looked now, saw the fill was 1944 even, but it's just, you know, if there's going to be a problem, that's where it's going to be, which triggers something else in my mind. Down here this morning, when the early morning, when the market went exactly to fill the gap, one of the things that I will tell people a lot of times, when you have a reference like that, you probably are going to be better off not anticipating taking that gap out. You're probably better off to wait till it actually happens. A lot of times people lead into the wind because they're so afraid they're going to miss the opportunity. And you know, everybody's going to do what they want. It's just something that I will point out. Okay, so now the market has rallied all the way back. We've got 8 minutes to go. It still hasn't taken out that high. So I'm probably getting some short covering, but I still don't have any indication of any serious new money on the buy side. But what else is more important? I don't have any indication that I've got any serious selling going on in this market. One tick short of the overnight. All I've got is very short-term traders in this market. That makes it very, very difficult markets to trade. It can be very frustrating. And if you understand that's who's dominating the market today, it's tradable. Julia, I heard your lips moving, which meant that you have some questions or something I didn't answer fully.
No, just more questions. Thank you, Jim. When D period started forming, would you be thinking excess low in C period, or would you be thinking that the market is one time framing down and could continue? So this is early, the first swing low there in the third 30-minute period for everyone.
No, I was thinking that when it went exactly to the
gap fill.
To the gap fill, and remember, let me go back to my.
Make it just the slide so it's larger if you can, Jim, from current slide.
Yeah, I'm trying to get it. Let me get it up. Okay. Okay. Remember what I pointed out. Well, they didn't get the slide I wanted, did they?
What do you mean?
Hold on. Okay. Remember what I pointed out in the first slide. The volume right here, the 18,000, this is why I use Window Trader. I like to see the exact volume. When I looked at this this heavy volume down here, and I see light volume underneath here, I see it go exactly to the gap. I'm now thinking I have an excess low. I'm now thinking a run back to the highs. Mm-hmm. And I sat there with it for quite a while because, you know, D period came down and took out one tick of it, but it never got into this heavy volume. It never took that out before it rotated back to the high. Excess and balance are the two most important concepts you look at. I thought that this volume was probably pretty good down here. Volume is very meaningful to me. I thought that was probably fairly important. I also thought there was probably still a lot of people caught short from overnight, and I thought some people got shorter trying to take it out this morning. So there was a lot of trading is very difficult, and most people can't handle it because there's so many things you have to take into account. And let me go back and say, you know, my not taking my bicycle ride this morning, which I'm very serious. I ride up to an hour every morning. The doctor called me this morning. I got the results of my annual physical I took yesterday. I'm going to be 74 here in a few days, and he was ecstatic about my blood pressure. He was ecstatic about all of my numbers. They were all improved over last year. I am very, very keen on making sure that I take time for myself and that I work out and eat right. And I think that helps trading. But when I was anxious this morning and I didn't take my bicycle ride, that tells you how focused I was in this market. One side of me, and believe me, one side of me was filled with greed. I really wanted to see that home run. I've been writing about the excess high. I've told people I didn't like the market, and I was basically talking to myself saying, Jim, remember what you talk about. You have to manage your expectations. And that's why trading's so hard, because most of us don't do a good job of managing our expectations. We did a webinar a few days ago, and I came on and I made a confession. I said I had a losing week the previous week. And the market-generated information, the stuff I'm talking about right here, was perfect. However, I didn't manage my expectations well enough. I wanted something that the market wasn't going to give me. But if you can learn how to think about trading, it's not as hard as you think. It's controlling the emotion. First of all, you have to have market understanding. So, I mean, a lot of times people, want to go to psychologists and psychological help for trading. Well, that's fine, but it only is going to be really relevant, in my opinion, after you understand how the market functions. Now, once you understand how the market functions, and if you find yourself you can't do the information you're looking at, that may be a psychological issue. But so much of it is, first it starts with market understanding. Second, it comes with understanding yourself and how to manage your expectations. That's the reason Julia came up with the idea of doing, the first intensive we did was 60 days. This one's going to be 30. But that's the reason she came up with this idea of understanding how hard it is for people. And she said, Jim, this stuff's second nature to you, and and to do a short-term, a 3-day seminar in a hotel or something, you really can't impart all the things that you've gained over the years. And I really hate it when she says over 40 years experience. I don't want her drawing attention to that. But it's true, and that's what we do, and that's what we're going to do again in the July intensive. Is, if we were there this morning, I have a one-way chat room. If they were this morning, there would have been a notation in the chat room. Be careful. Overnight inventory is 100% short. It's a very prominent point of control, and we would have pointed out where that was. And we come down and said, okay, the target, the destination trade, or the support level is the gap. Remember, I wrote it. Well, some of you wouldn't know, but those that get the reports and know that what I wrote yesterday, coming into today, was the market attempted to fill the gap yesterday. I wrote that it's, and I've written this many times, the odds are very low on the first attempt that a market trades to a very important gap, and the more visual that gap, the more relevant it is from short-term trading. The first time down to that reference, in this case going lower, the odds are very low that you're going to fill it the first time. And the reason the odds are so low is because the responsive traders see it as a deal and they're going to step in right away. It's very similar to what a merchant expects to happen with the after Christmas sale. You got an item that was $10 before Christmas. He didn't get rid of all of his inventory. He marks it down to $7.50, hoping that somebody would say, oh, respond to $7.50. It was still, well, that's a great deal. So he gets those responsive buyers, take the inventory off his hand, bring his inventory back to normal. Now he can move it back to the normal $10. So that's kind of what I saw happen yesterday. Then I think the wording I used coming into today, be very careful. The second time down to an important visual reference like that, it's not as enticing for the responsive buyers to be active. So the odds are greater that it would be filled. So I'm focused on that gap. I'm focused on where it hit. But once it goes down here, we would have had a little chat out here and say, okay, the gap was not filled, was filled. It remains a support level. It looked like there was buying interest, and you'll see it right here. So, I mean, those are the kind of things that we'll do, but they're also trying to get you in the habit of knowing what to look like, helping you know how to distinguish between who's dominating the market today? Is it short-term, day time frame, short-term, long-term? My golly, Jim, I don't know. I said, well, that's the reason we go through it a day in time. That's why I made the slides today, to give you some idea. It's not very often you get an example where it's just so clear that it's pretty much the day and short-term time frame. But remember, once you know that, that helps manage your expectations, and then you say, more than likely, when you've got that going on, the chances are that you're going to get more rotation. And what have we had? More rotation, and we've had inventory. We've got too long, too short, too long. One of our earlier participants, I think it's Chuck out in New York, sent an email to Julia one day, and he said, you know, I've been looking at this, and on these rotational days, I find there's generally three auctions. You know, one up, one down, one up, or something like that. So those are observations that you start to make. But if you get all excited, think, boy, this break today, this is going to be the big one, even in J period. Well, when it happens late in the day, and you don't have a good high, and you know it's late, you're very fat up here, which means you only have short-term trading. This breakdown here is more than likely short-term money trying to liquidate. If it was anything more than that, this market would be more elongated. So you say, okay, I don't have great expectations for a break down here. So, I mean, you start to put the odds together and start to learn how to think about the market. It's not about following price, and that's one of the things that we keep coming back to. Price is an advertising mechanism. Time regulates all advertised opportunities, and volume measures the success or failure of those advertised opportunities. And since time just came out of my mouth, that went through my head this morning. The market went up, it rallied back in F period, one tick prior to the early morning high, which was one tick prior to the halfway point overnight, and then the market sat here for almost an hour and a half before it broke. So when the market goes up here the first time, you think there's a pretty good chance that we're going to get through this because it's a poor high. There's no sign of any excess up here. So time is on your favor. The longer the time, the longer the market sits here without going through that level, the greater the risk and the greater the sense that time is going to turn against you. Let's think that through together for a second. The people that got excited and bought and ran the market up here, think about it now. If they've been sitting there, a lot of them been sitting there hour and a half long the market and getting no additional reward for it. Long the market, getting no additional reward. It's a rotational day, so what do you think short-term inventory is? It's very long. When that happens, all it takes is some little room or something. One person starts selling, and that begets more selling, and you get a liquidating break, such as you had right here. But if you get inside the head of the people you're competing against up here, and you say, well, wait a minute. All these people that bought this morning, they were long in F period, G, H, and in part I, and they're getting nothing for it. Uh-oh, start thinking, what are the chances that they're going to liquidate? You can get that feeling that they haven't gotten much for the risk that they took, and the odds of this market showing a liquidating break are much increased. It's exactly what happened. When I said today, when this was coming up, and I told you where I bought, which I don't normally do, but I said I just pushed and got out here at 1944, and I said, why? Because if there's going to be a problem, it's going to be right up here. So, and that's exactly what happened. Does it always work that way? No. Sometimes we'll be on the intensive, and I'll do that, and it goes right through here, and I say, boy, we don't need him. But you can always repurchase on the other side. Anyhow, I've done a lot of talking. More questions, Julia?
That's great, Jim. Thank you. We have several traders that are pointing out that, you know, it was the halfback of the overnight session, but just to mention and let them know that we hear you, it's also the pullback low from the pit the day before.
Okay.
Okay. So
yeah, I only use, this is the pullback low from the pit. I only use that reference. I only use that reference when the market is above it. But now, let's take a look. I'm glad somebody brought that up.
We had several.
Because several. And let me show you why That's important. Remember, I said I only use the normally all I look at is the overnight high, overnight low, and I want to know if it's long or short. For those that are new to us, the overnight pullback low was right here. In other words, when the market was rallying on Tuesday, and late in the afternoon it pulled back, that was the low it went to. That becomes a trading reference to us, because if there's anything to change today, it's going to take place below that pullback low. If I just trade above that pullback low, no change today relative to yesterday. But take a look, where did the market accelerate overnight? It accelerated once it got to that pullback low. And why do you think it accelerated there? What do you think, short-term money, what do you think was just below this FH period low? Short-term stops. So that's all, what you got. That's why you got a double distribution last night. You had a liquidating break, fueled in the second set, which giving more fuel by hitting the stops below the pullback low. Then they got more stops below yesterday's low and below last Friday's low. A lot of times we call it the Firecracker Effect. It got this set of stops, which was enough to propel it to this set of stops and to this set of stops, and particularly in the overnight market, because the overnight market is so thin. That's why I don't like to take future trades home overnight in long or short futures positions overnight unless they're hedged. There's too many crazy things that can go on. Anyhow, I'm glad you pointed that out. It's helpful. I think you brought it up for the wrong reason. However, because it wasn't going down, but I think we go to the second step and say what was below that stops. So that's why we got the acceleration and got the double distribution down last night. So it becomes this is something changed right here. We come back up to here. Nothing has changed back up to this level. But anyway, thank you for bringing that up. I see it a little differently, but I see it as very important, and thank you.
Okay. Thank you, Jim. How do you take advantage of the analysis for a short-term trade? Will Jim give out some kind of trading alert? Well, no, he'll talk about when he sees an opportunity, and clearly, because of all the background information of traders that know Jim's methodology, clearly a very visual level, like a gap fill with huge volume coming in, the structure to lean on to get in and have an idea of where it's going up to, particularly with overnight inventory short. We've seen that adjustment happen. So he'll frame it out, but what we find is that there are traders that do 15, 20 trades a day. We have traders that do 1 or 2, maybe 3 trades a day. So not every opportunity is for every personality. Does that make sense? Am I saying that correctly, Mr. Dalton?
Yes, you are. And I will point out sometimes that here's a trade area that a short-term trader might be interested in. It's not something that interests me because of my time frame. I'm looking for 2 to 3 trades a day. I'm looking for kind of a controlled atmosphere where I get 2 to 3 trades a day, and I only want to do those trades where I have something to lean on. Early this morning on the C period break, I have the gap to lean on. I can have a stop slightly below here. This trade, I didn't have as neat a place for a stop as I would have liked. However, I thought there were pretty good odds that I'm going to get pulled back up into this area, and so my stop was shortly below the pullback low. That's a little wider than I'm sorry, the prominent point of control. It's a little wider than I like, but that's just my job is not. My job is to help you, at least as I see my job, is to help you learn how to think about the market. I want to facilitate your ability to understand the continuous two-way auction process, understand where there are levels that there might be opportunities. But the minute I tell somebody buy it here or sell it here, that does absolutely nothing to build your own confidence. More than likely, that destroys your confidence, and it takes a tremendous amount of confidence to be successful as a trader, whether a day time frame trader or longer. But our goal, and the reason Julia came up with this idea, is be able to spend a reasonable amount of time. Like I say, we'll spend at least 8 hours a week in live sessions like we're doing right now, working with you on the markets. We'll have the ongoing chat room, and you get a couple of reports. So we're constantly trying to help you know what to look at. The actual make the decisions, I can't do that for you. I'm not going to make the same trades you do, and I personally don't think that's beneficial at all. But I do think we want to help you know, facilitate your understanding of the continuous two-way auction process, what is important and what is not important as we trade markets. I'm sorry, I got a little wordy there. Another couple questions.
No, that's great, Jim. Thank you. We got, what was the best trade today for you, and what was your landmark or, your decision point for the J period reversal? Because it was against value, which she raises a good point, too.
Oh, yeah, it was. Okay. As I said the other day, if you're against value, if you're going to trade against value, do you have to be right quickly or slowly? You have to be right fairly quickly. And the market made the low, and at one time framed up till the high. But think about it. It was rotational. It was rotational. I thought we showed the other slide. I just thought I was getting inventory adjustment back and forth. I did not have an aggressive high, so I didn't have any sign I had longer-term money in here waiting to sell them the market. It was a rotational day, so my decision was to go with the rotation. But when I'm fading value, I have to be right very quickly. But it was a rotational day all day long. I thought the day time frame and short-term traders were in control, and I was fairly comfortable with the trade. Okay. Another couple questions.
Sure. Thanks, Jim. Real quick, when you talk about developing value, is it how value develops today, or is it always in relation to how value develops, in relation to yesterday's session, the prior pit session?
How value develops today relative to yesterday. For example, today's value is developing lower. So so I have one time frame here back and forth. For example, let's take a look at this. Yesterday, we got a late rally yesterday, and I was listening to some of the traders that fooled some of the big ones yesterday. I think you had a short covering rally because they pushed too hard. But value was lower. Value was lower. I made a comment that, I wanted the market to go down. I had an excess high. I thought this was bogus. I went home short on this rally. I do it with puts. It's a little different. But again, and now what did I need to be right? I need to be right pretty quickly. I need to get lower value today. And that's what we wrote up last night. If there's anything on the downside, you need to get lower value. And of course, that's part of what contributed to my excitement when I came in I woke up this morning, because I had a chance for the home run. And that's where I had to manage my expectations. And the information I was looking at, I say, first of all, overnight inventory is 100% short. Not particularly healthy. If overnight inventory is 100% short, what we say is, if the market is weak, the market will immediately disregard the overnight inventory. So, and it does happen sometimes. But if in fact this market was weak this morning, it should have gapped lower and gone. By the time we got to the opening, we crept back up to here. So there's a pretty good chance that this market was very short, but it didn't have that feeling that there was any real anxiety to sell. I mean, people could have sold at almost all-time high prices, and nobody came out of the woodwork. Nobody was interested. All we had was some liquidation in there. Okay? I don't know what I started. I got off on a tangent, but go ahead. Another couple of questions.
Okay, great. Thank you, Jim. When day and short-term traders are in control, how do we know that intermediate or longer-term traders are stepping in and are now activated?
Well, all of a sudden you'll see a change. Take a look at when we talk about going back here, looking at yesterday, we had an afternoon pullback low. Okay, well, guess what? If they stepped in on the sell side, we'd be down below this. And we weren't. By that time it gets fat. More than likely they're not coming. More than likely they're not coming in that late in the day. Now, there are some exceptions. Every now and then you'll see a nothing day, and out of nowhere you'll get a major change in the market midday. Well, that's a sign that out of nowhere, longer-term money did step into the market. But you'll see it, you'll get a double distribution, and you'll see a total change in the market. It's not something that is hidden by stealth. When they come in, you're more than likely gonna know it.
Yeah, the double distribution.
Yeah, you get the double distribution, which are always a sign the market will start one time framing. You'll see, and volume will pick up, activity will pick up, volatility will pick up. You'll feel a whole difference in the market. Didn't happen today. Let's take two more questions. Go ahead.
Okay. Would you consider today's overnight inventory adjusted?
Yes. Yes,
okay.
I would. I mean, overnight inventory is generally weaker money. They're not going to hang around. Usually it's about a quarter of what it is during the daytime frame. The longer term, I mean, people have been with me a while know that what I'm going to say, but longer term money doesn't trade heavily overnight simply because if they do try to get any order of any size executed, there'll be no liquidity. Their fills will be spread out over a mile. So normally you get smaller traders overnight. Occasionally if there's something really big going on and the longer term money doesn't care about the fill, they just want in, well, that's when you'll see the big gaps and everything else. But we're not seeing that in here. But I would say that most of the people who are short overnight, they've covered by now.
Okay. Thank you, Jim.
More questions.
Thank you. Tomorrow is the rollover, or maybe it goes into Friday. Does this affect your analysis?
I get that question all the time, and I'm really terrible on that. I really don't. What I'll do, the rollover is tomorrow. I will continue to do my analysis on the June contract for tonight and tomorrow, because that's when the roll takes place. The following day, I will start following the SEP contract. And when I start following the SEP contract, then I go to I then start using the bar chart for SEP only in order to be sure I'm looking at what's going on just relative to the SEP contract. That is, the roll is not something I'm an expert at. But tomorrow I will trade June. The following day I will trade SEP. And my analysis tonight will be on this contract, and then I kind of fudge it into to the next day. When I do my analysis tomorrow night, I will do the analysis for the SEP contract. Tonight I will do it for the June contract. Tomorrow night I will do it for the SEP contract. Tomorrow I will trade June.
Thank you.
Now let me take a second. One of the things that the week has been very void of news. There has been absolutely no real meaningful news for the first 3 days of the week. And that sometimes when markets are pretty much in balance, and this market still, even though we've got a couple of days of lower value, the market's pretty much still remaining in now what is going to be a 4-day balance. When a market is in balance, the message that market is delivering is to you is it wants more information before it begins its next directional auction. Now tomorrow we have jobless claims at 8:30 Eastern Time. We have retail sales. We have import-export prices and business inventories, which isn't as important, coming up at 10 o'clock. And then we have PPI on Friday morning. So we do have news coming up tomorrow. So I would expect that we will see an increase in activity and volatility, that this probably is a market that's fairly well starved for news. Okay, let me take one more question before I wind this up.
Thank you, Jim. What's your expectation for tomorrow after the liquidation the last 2 days?
I don't have any. The market is in balance. I just said it. The market's probably starved for news. I will be very flexible coming into tomorrow. I do know I have a very prominent point of control that hasn't been revisited. I have a very prominent point of control here that gets invited to be revisited tomorrow. So I'll be fairly cautious tomorrow, and I like to go with the auctions. The ideal thing for me tomorrow would be a gap higher or look above. I will treat today as a balanced day, and I will apply the balanced trading rules to today. Now, what are the balanced trading rules? Rule 1, when you have a balance, and I'm going to treat today as balanced, when you have a balance, Rule 1, the market remains in balance. Rule 2, it looks above or below balance and fails. If it looks above or below balance and fails, the destination trade or the objective becomes the opposite end of that balance or trading range. The other rule, the last rule, is look above or below the balance and accelerate higher or lower. So that's really, I'm going to apply the balanced trading rules as I write up the report for tonight. It's going to focus on the balanced trading rules for today, which is a balanced day, but it's also then going to extend it to the balance for the last 4 days. For example, if it goes to the upside, it breaks out to the upside, then you're looking at a test of the all-time high. If you break out to the downside, not only did you break out of the balance for the 1 day, but you broke out to the downside of a 4-day balance, or you break out to the downside and fail. So I will be looking balance from very short term, but I will also be looking the 4-day balance down in here and say, do I look below it and fail? Do I look below it and accelerate if I get that opportunity? So the balanced trading rules, but I don't have an opinion or a bias coming into tomorrow. I had a bias coming into today, but I don't have an bias coming into tomorrow. This is a very mechanical low, pretty balanced, 4-day balance, and I'll be pretty objective coming into tomorrow. All right.
Can I ask a question that kind of goes with that? We got just 2 more, if I could, Jim.
Sure.
One, has Jim seen other markets this squatty over this long a period of time? Does this occur often, or is it rare?
Yes, I have seen it. I don't want to sound like an alarmist, but the last time I saw something similar to this was 1987, prior to the big break in 87. I think the conditions are somewhat different these days, but combined with the very low volatility. And you've heard the discussion that the Fed has raised the issue now that maybe there's too much complacency, translated, which means maybe they've caused a bubble in asset prices. Stocks should be going up on their own, not because the Fed's manipulated the market. But so I have seen this choppiness before, but it's just another way of saying there's a great deal of uncertainty in the market. What you don't want to do is get it into your head that there's disaster looming or a great rally looming. Take it, right now we've got a 4-day balance. Remember, one of the things that they said, that the old saying, markets can be irrational a lot longer than you have money to handle that irrationality. Just stay with what we're talking about. Keep it on a short-term basis. Did I have a chance for the break today? Yes, I did. I have an all-time excess high. I will continue to focus on that. For example, if I build lower tomorrow, now I've got lower value, lower value, lower value. And what happens, and I should go in depth in here for a second. As I've said, at this point in time, I don't see any evidence of the longer time frame being aggressive on the sell side. That doesn't mean there aren't some innovative sellers. And if you really want to know what innovative sellers are, the best thing is to go read my book, Markets in Profile. We talk about it pretty aggressively in there. But sometimes what happens, let me put 2 categories. You got the longer term portfolio managers that manage billions and trillions of dollars. They are generally slow to get out of the market. They are generally slow to panic. The discussions you will hear coming out of them right now is there's nothing wrong with this market. It's been a rolling correction. It's very healthy for the market. This usually means higher prices. Well, keep in mind, these people always find a reason for higher prices. I've listened to them. I'm 74, will be shortly, and they'll almost all find a reason for higher prices. But whatever it is, they generally are not early to sell. So that's one category. Those are the long-term, the money managers, big names that you'll know about. They buy and hold stocks for extended periods of time. They're generally bullish, and they'll generally tell you to buy and hold stocks. That's the best way. Now you've got another whole group of traders, and that is the very serious trend traders. Trend traders, by their very nature, are never going to be buying at the bottoms and selling at the tops. If they attempted to do that, they really wouldn't be trend traders, because they need to see some evidence the trend is underway, and they need to see some evidence that a trend is starting to reverse before they really get, before they put good money in or out of the market. This is why I've never followed trend traders, or never liked trend traders. They make a lot of money when their trend is in favor, but they're almost always a little bit late to get in, and they almost always overstay the market. So now with those two categories, let me walk through something. We have an excess high, we have lower value, and what I call the drip effect. Let's say this goes on for a few days. Now put yourself inside the head of some of those long-term portfolio managers that were so complacent and had all these reasons why stocks were going higher. Then as it starts to drip on them by seeing lower prices every day and seeing their portfolio down every day, they start to feel the same psychological pressures the rest of us feel. Now go over and think about these longer-term trend traders. Okay, they're very complacent with their trends, and all of a sudden it goes lower and it goes lower, and all of a sudden their price-based systems start to say, well, this trend's starting to reverse or getting very old. So it's not uncommon for a market to start down slowly, have excess high, lower value, and several days of lower value, and all of a sudden, out of nowhere, you start to get the market really accelerate on the downside. And what I refer to that is the drip effect, that it is dripped on these complacent long-term money managers as well as the trend traders long enough that they succumb to the same psychological pressures that get all of us as short-term traders from time to time. It's the same for everybody. It just may be a little longer time frame. All right. Let me just very quickly, I know I've worked it in, but the 30-day summer intensive, July 7th to August 8th, 5 weeks, about 8 hours a week that we will be live. We use just the S&Ps. Occasionally I'll look at another market for somebody. It'll also include the interday chat dialogue that you'll see in your screen. I can put out chats throughout the day. Open enrollment, you start as soon as you enroll, even though the program doesn't start till July 7th, if you enroll today, you start getting the reports, the nightly report and the morning report. And also you also get a $50 discount for early enrollment. Anyhow, thank you for being with us today. Thank you for allowing us to work in the commercial, and we hope that we see you in July. And I think, Julia, we have what, 2 more webinars scheduled, free webinars scheduled in the series?
2 more.
Two
more, 18th and the 26th of June, and then it's your birthday week the week after that. And then we'll start the intensive the week after that. So we're pretty full throttle here.
Okay. Thank you all very, very much. Have a great trading day tomorrow.
Okay. Thank you, Jim. Thank you, everyone. This recording will be posted at our site, webinars, recorded webinars, a little later this afternoon.